calculate it. So as you look at this list, this is the order that we're going to go through for the lesson. So if there's one that you want to see in particular, just kind of skip ahead as to how far into the lesson that you think that might be. Okay, so on the left-hand side of the screen, I have Microsoft Excel pulled up. And what I'm going to use that for is just showing you the calculation for some of these different stock terms. Over on the right-hand side, I have MSN Money pulled up, and I'm going to go ahead and type in the ticker Johnson & Johnson. And for those of you following along with my book, this is the same ticker that I used for all the example for the common stock terms, and it's also in the same order, so that might help you out as you go through it. So the first thing that we're going to start off with is the shares outstanding. Okay, and as you know, the shares outstanding is just how many pieces Johnson & Johnson has been divided up into. So there's a couple different places you can find where that number's at. The easiest is right off the very top level page. If you scroll down to the bottom, you'll see that it says shares outstanding right there, and it's 2.75 billion shares of Johnson & Johnson. Okay, so for that number, there's not much of a calculation. It's just 2.7 billion. Okay, and that's all you got to do. If you wanted to find that number off of one of the financial statements, you could go to the income statement and also the balance sheet, and you can find it at the bottom of both of those sheets. So here I'll show you that real fast off of, let's say, the balance sheet. So you pull up the balance sheet and you go down to the bottom, and at the bottom of the balance sheet you'll see it says total common shares outstanding, and you can see there's the number right there, which is a little bit more specific than the number off that top level page. If you were going to find preferred shares, this is also where they would have those numbers listed. Okay, so the next number is the earnings per share. So let's go back to the top level Johnson & Johnson page. Okay, and this is the page that you'd come to if you just typed in J&J. And the EPS stands for earnings per share. Okay, and this is a really important number, one of the most important numbers you can possibly know, because this is the bottom line profit that one share makes for an entire year. Okay, so one share for the entire year, and it's the bottom line profit. So this number, all the employees have already been paid. All those numbers are already taken. This is the money that's left over at the end of the year per share. So we can find the EPS by just scrolling down off the top level page, and you can see how it says EPS 3.64. So $3.64 per share. Okay, so where they're getting that number is off the income statement. So if we go to the income statement and we go to the bottom of the income statement, you can see it says net income, and the net income is $9,672 million. Okay, so what we're going to do is I'm going to take that number, okay, and in Excel, in order to do calculations into a cell on Microsoft Excel, you're just going to type equal sign. Now it knows that you're going to be doing a math problem, okay? And what we're going to do is we're going to take that 9.6 billion, we're going to type it in as 9672, okay? And I'm just going to type it in as that number because I'm chopping all the zeros off the end, and whenever I divide it by the number of shares outstanding, I'm also going to drop the zeros off the end of that, okay? So what I got to do is I got to go down and look at how many shares outstanding there are on this company. And here's the basic weighted average shares, which is our number right here for the number of shares outstanding. Okay, and that's 2,736. And that's actually 2.7 billion shares. Okay, but since we chopped the zeros off the net income, we're going to go ahead and chop the zeros off of the number of shares. So when we hit equals, you can see that there's the number that we saw on the top level page, which is $3.53 per share. Okay, we took all that net income, divided by the total number of shares, and that gave us the 3.53, which is the EPS, or earnings per share. Now, sometimes you'll hear the term diluted EPS. Okay, and what this is, imagine a company that has all these shares, and in order to keep their employees happy and working hard, a lot of companies provide their employees stock benefits. Okay, so what the company does is instead of like actually buying shares off the stock exchange and giving them to their employees, what the company does is they simply annotate that on record that they've given 1,000 shares to employee so-and-so, or they've given 2,000 shares to employee X. So When they do that, what they're actually doing is they're diluting the value of each share because they're basically creating more shares even though they're not on the market, okay? And what that's called is diluting the company. So when you look at this income statement and you go down here, it says diluted weighted average shares. And you can see that that number is higher than the number that we just used, which is the number of shares that are outstanding. Okay, so this number is the real number of shares that are outstanding opposed to the number that's being reported as being outstanding. So if you want to get a more accurate EPS, you're going to want to use this number. And when you use that number, it's called the diluted EPS. Okay, and so how we figured out the diluted EPS is really similar to the way we just figured out the EPS. So let's go ahead and hit the equal sign. And we're going to go ahead and put the net income in again. So it's going to be 9,672. Okay, and we're going to divide that by this diluted weighted average shares, which the number for that is 2775.3. And when we hit enter, you can see that the diluted EPS is actually lower than the actual EPS that's being reported. So this number is more accurate, and this is the number that you're going to want to use whenever you're calculating whatever. Okay? And you can see that down here they actually have that number calculated for you at 3.49, which if you rounded this, it would be 3.49. Okay? So that's how they're calculating that. Okay, so the next number is probably my favorite number to quickly look at a company, and that's the price to earnings ratio. Okay, so let's go to the top level page and I'll show you where that number is reported. And for Johnson & Johnson, off the very top level page, as you scroll down, you're going to see that the PE ratio for Johnson & Johnson is 18.57. Okay? Now, that number is really significant because that number means, this is the phrase that I want you to say, for every $18.57 you spend buying this company, you can expect $1 in return 1 year later. Okay, that's the magic phrase. So if this PE was 100, okay, like Facebook, you'd have to say, for every $100 I spend buying this company, I can expect $1 in return the following year. The $1 never changes. The PE is what you're going to say at the beginning of that sentence. Okay, so for Johnson & Johnson right now, we've got to spend $18 to make $1 in a year. Okay, so that's not all that great. You can find a lot of companies that have a PE of 10 or lower, and that's really what you're looking at for the current market conditions. Okay, so how this number is calculated is really easy. All you got to do is take the price, okay, and we figure that out right here, of $67.78. So we're going to go ahead and hit the equal sign, 67.78. And you can see it's showing you what the ratio is. P on the top, which is the price, which we just looked up. And then the E on the bottom is that EPS. Okay, so we're just going to hit the division sign. And our EPS is 3.53. I'm just going to use the standard EPS and not the diluted. And when I hit enter, it's $19.20. It's actually 19.20 with no units because you're dividing dollars by dollars. But if you're going to say the sentence, you could say, for every $19.20 I spend on this company, I can expect $1 a year later. Now you're going to see that the the PE ratio off this top level page is different than what I just calculated, and that's because this number here isn't updated. So the number that I actually calculated is more accurate than what's being displayed here on MSN's top level page. They need to actually update that. Okay, so the next number is the volume, okay? And that number isn't something you have to calculate. That's just something that's going to be reported. And that can be found right here on the top level page, and it's 12.49 million shares in 1 day. So for the 9th of July 2012, there was 12.5 million shares traded for Johnson & Johnson. Okay, and if you go back to the volume lesson that I have here in course 3, that'll give you it'll give you more information on volume. But that's where you would find the number off of MSN Money. Okay, so the dividend rate. So this is another number that you don't have to calculate. It's just reported. And so when we go over here and we look at the top level page, this dividend rate here is actually $2.44. This is dollars. This is the actual amount that you'll receive for the whole year. So if you own Johnson & Johnson, you'd take this number, divide it by 4, and that's what you'd get every 3 months. And if you added up all those payments for the whole year, you'd get $2.44 for one share. Okay? So this is $2 and, let me put the dollar sign, $2.44. Okay, the dividend yield. In order to calculate the dividend yield, all you're going to do is take the rate divided by the market price. Okay, so what we're going to do is we're going to hit the equal sign. Okay, and our rate, like we just said, is $2.44, and we're going to divide that by our price, our market price of $67.78. Okay, so we're going to go 67.78, and we hit enter, and it comes up as 0.03599. Okay, so this is a percent, okay, and it's 3.59%. Over here you can see it just says 3.61. There's no percent sign here, so this can confuse people. They might think that the rate and the yield are the same, but they're very different. This rate is dollars. The yield is a percent. Okay, so the debt to equity ratio. Okay, so this number is reported on the top level page as well. So if we go here to debt to equity ratio, you can see it's 0.32. That's good. We're looking for anything under a 0.5. That's going to give us a nice healthy company. So how this number is calculated is you have to go to the balance sheet in order to calculate that number. So when we go to the balance sheet, we go ahead and click here. Okay, and as you come down, the debt to equity. So when we're looking at the balance sheet, we're going to see the current liabilities and the long-term liabilities, which are reported down here as total liabilities. But when we look at this, okay, you're going to see anything that has debt. You see that word debt right there listed in these liabilities sections? Those are the numbers that you're going to add up. And you're going to add up those debt numbers, and then you're going to divide that by the total equity right here. Okay, so let's go ahead and do that. So we go ahead and hit the equal sign, and I'm going to put a parenthesis here since we're going to add up the different debt sections. And as you can see, the first one that's highlighted there is the 6,439. 6,439. Okay, and we're going to add that to the next debt number that we have, which is the total long-term debt, which is the 13,010. Now remember, these numbers are all in billions. Okay, so that's actually 13 billion, but we can put it in here because we're chopping all the zeros off. 13,010. Okay, and I don't see anything else on there that has debt listed with a number next to it. This one has debt on it, but it's the number 0, so we're not even going to list that. So we're going to add up those two numbers, okay, and we got to do that addition first before we do the division. So that's why I have the parentheses around it. And then we're going to divide it by the total equity, which is down here at $61 billion. Okay, so we're going to put in 61,366. Okay, and then when I hit enter on Excel, it's going to give me the answer of 0.31. Okay, and if you remember on the top level page, it was 0.32, and if we rounded this, that's exactly what we would get. So that's how your debt to equity ratio is calculated. So the next number is your book value. Okay, now the book value isn't calculated off the top level, or it's not displayed on the top level page. So let's go to the top level page. Your book value isn't going to be listed here, but if you go to your financial highlights tab, you can go ahead and click on that. You're going to see that they calculate the book value for you right here at $22.35. Okay, but you're probably wondering, how are they calculating that number? So let me show you how to calculate that number. So you go to your balance sheet, you go ahead and click there, and when you come down to the bottom, you can see that you have this total equity of 61 billion, and you have 2.7 billion shares. Okay, and all you're going to do is just divide the equity by the shares outstanding. So let's go ahead and do that. So the book value is equal to 61,366 divided by 2,745.72. And since we chopped all the zeros off on both of those numbers, we can go ahead and do that. And when I hit enter, we get a book value of $22.34. Okay, the next number, the price to book value number. Okay, now the price to book is pretty easy to calculate. All you're going to do is you're going to take the price, which is $67.78, and you're going to divide that by the book value, okay, which we just calculated at $22.34. So let's go ahead and do that. We hit the equal sign. The price is $67.78. We're going to divide that by the book value that we just calculated above, which is $22.34. And we hit enter, and our price to book value is $3. Okay, so that means that for every $3 you spend buying this company, you're going to get $1 of equity or book value in the business. Okay? Now, I want to show you another spot that's really interesting on the price to book, and that's if you go to the Key Ratios tab on MSN Money. If you click there, and you go to the 10-year summary right up here at the top, you're going to see that they have historical data on that price to book number. So you can see right now the price to book is 3. At the end of or at the beginning of 2012, it was 3.13, and it's always been hovering around 3.0 to 4.0, and then at about 7 to 10 years ago, it was clear up to 6. So a person could maybe argue that the price to book on this business is really low, and that maybe it's an investing opportunity. I think that that's kind of a bad approach. I think you always got to look at what the earnings are and how much of a dividend and how much the book's grown in order to properly value the company. So I would try to have you avoid valuing a business through this price to book ratio. But this is I use the price to book ratio in order to assess the margin of safety that's involved with the company. So with Johnson & Johnson, there isn't a real large margin of safety because everyone's trading this company for an enormous premium, 3 times the book on the business. And so if the earnings on this company would drop, you would see the market price significantly drop because there's no equity behind that market price. So when you see a high price to book, that typically means that you have a very low margin of safety. Okay, so while we're on this page, which we went Key Ratios, 10-year summary to get here, you can see the equity growth. When we go down here and we look at the book value per share, you can see it went from 7 to 9 to 10 to 13, clear up to 20.95, and in the last couple months, it's actually gone even higher to $22.34. So this is what we're talking about when we look at the book value growth, is this number right here going up that chart. Now, as you get more comfortable with the numbers, you might be inclined to look at the equity growth off of the balance sheet. This is bad. You don't want to do this. And let me show you off the balance sheet. When we come to the balance sheet here, and we look at the equity, we can see that the equity went from 59 billion to 62 billion to 61 to 57 to 61. So a person might look at this and say, oh yeah, that equity really isn't growing all that much for the last 5 years. Okay? And that equity really hasn't. But what has changed is the total number of shares outstanding. That number has changed. And when that number changes, it changes the book value. So whenever I'm assessing whether the company is actually having true equity growth, I'm always looking at the book value growth opposed to the total equity of the business. Because I might not know how many shares there are outstanding and what those shares are changing at, because I can only buy it per share. I can't buy the whole business. So that would be our equity growth there. And if you were going to figure out that number, you could use the Buffett's Books Intrinsic Value Calculator, the top calculator, in order to figure that out, how much growth that is per year. Okay, so the return on equity, one of Warren Buffett's favorite numbers, which you guys just recently saw a previous lesson about. So how this number is calculated is you're just going to take the net income and divide it by the equity. So how we do that, let's go ahead and find the net income for Johnson & Johnson by going to the income statement. So when we pull that up, we scroll down and we look at the net income, which is right here at 9.6 billion. So let's go ahead and hit the equal sign, and we're going to put in 9,672, and we're going to divide that number, which our net income's right here. We're going to divide that by the equity, which will pull off our balance sheet. We scroll down, and that is 61 billion. Okay, so we put in 61366, and we hit enter, and you can see that the return on equity comes up as a percent. So you got to move the decimal place, and it's 15.8 if we round it. 15.8% return on equity, which is phenomenal. That's really good. Okay, if you wanted to find the historical return on equity for Johnson & Johnson, we can do that as well by going to the Key Ratios again, go to the 10-year summary, and as you come down, you can see what the historical return on equity has been: 16, 23, 24, 30, 24, 28. These numbers are phenomenal. This is a business that knows how to reinvest their money. That's what that tells me. So when they're not paying me a dividend, I'm fine with that because you know what? They're making a whole lot more than I probably could reinvest the money at with my dividend. Now, whether the company's a good price, that's a whole different factor, and that's something that you're going to have to figure out before you dive into this company. Okay, so the last thing is the current ratio. So in order to figure out the current ratio, we have to go to the balance sheet. So we're going to go down here, and unfortunately the current ratio isn't really shown on any of the, it's not calculated for you anywhere, so you have to do this calculation if you want to figure it out. Okay, and in order to do that, you're going to go to the balance sheet, and you're going to look at the total current assets, and you're just going to divide that by the total current liabilities. Since anything listed as a current asset or a current liability is either going to be paid to Johnson & Johnson in the next 12 months, or it's going to be paid out of Johnson & Johnson in the next 12 months, this gives us a really good idea of the short-term health of the company. So whenever I divide the asset divided by the liability, I immediately know if Johnson & Johnson's going to have to take on more debt, issue more shares to cover that difference, to make up that difference of them losing money. I know that right off the bat. So when we do this, we're going to go ahead and hit the equal sign. And we're going to divide the top one number, which is the current assets, which is 57,000,007. I'm going to divide that by the bottom number, or the current liabilities, which is 21 billion. So I put 21,198. And when I hit enter, I see that the current ratio is extremely healthy at 2.68. Okay, and all that means that for every $2.68 that Johnson & Johnson receives, they only owe $1 out. Okay, that's what that ratio means. So that's a good thing. When that ratio means they receive $1 and they pay $1, your next 12 months might be kind of interesting, and there's a strong chance they're going to have to take on some debt because they might not be able to cover all their responsibilities. So anytime you see something, I always look for a current ratio that's over 1.5. So this concludes Course 3, Unit 4, Lesson 4, which is our common stock terms. I hope those calculations helped you out a little bit. I know I didn't really put much analysis of how those terms are important, but as you would be using all the lessons prior to this, I hope that that's a good reference for you in case you can't remember what a term is or how to calculate it.